getting joined into the room. We are happy to have you for another edition of Community Capital Live. For those of you that are new, this is a partnership between several organizations, all working in the impact and local investing space. So we've got the Main Street Journal, which is really the hub for local investing. We have the Impact Alpha, which really is the hub for impact investing. We also sponsor organization is Neighborhood Economics, which is a great series of conferences and other convenings of people in this space to really plan and create action. And we also have the Mindful Marketplace on Biz Radio US about social entrepreneurship, impact and community investing, and worker ownership models of business. So really happy to have, grateful for all of that. I'm also want to make sure we introduce our panel, and then we'll get into our guest today. I guess we're all very excited about our first one of the new year in 2025. So our panel today, we have Michael Schuman, who is the author of several books on local investing, including his most recent, Put Your Money Where Your Life Is. He is also the editor-in-chief, presidente of the Main Street Journal, which really is, as I said, is the place to start if you're interested in investing your money locally. We also have Kevin Jones, who is the co-founder both of the SoCap Impact Investing Conference and Neighborhood Economics that I mentioned earlier. We also have, that's it for our panel today. And then I'm Joel Skeen, host of the Mindful Marketplace show on bizradio.us. So today we have Havell Rodrigues from the New Majority Capital up in Boston. Havell, thanks for joining us. We're happy to have you.
Thanks, Joel. Happy to be here.
Yeah. We're excited to let you talk to the audience here about the fund, about how they can, possibly utilize the fund, learn more about what your fund is doing. But I wanted to start by just kind of asking you more, when it comes to New Majority Capital, what was the groundwork like that led to the creation of the New Majority Capital Fund?
Yeah, we started with the mission of, what can we do to help close the wealth gap? And, we looked at several studies, and it's, quite obvious asset ownership is one of the ways, like real estate being a, prime example, where somebody acquires real estate, it depreciates in value, they can pass it on, etc. Another asset that we came across is business ownership, business equity ownership. And when you actually look at the reasons behind equity gaps, you'll see the stats showing like 30% is due to business ownership, 50% or more is due to real estate. Because nobody was focused on this business ownership piece, we said, let's focus on that. We all have backgrounds as entrepreneurs, as investors, and experience with small businesses. And that's what sort of led to us focusing on that particular solution. And the fund was sort of built out of filling the market gaps to make that solution come alive.
Yeah, and that solution you're specifically talking about, is that the entrepreneurship through acquisition?
Right. Yeah. So it's all about, how do we help underrepresented entrepreneurs be in a position to buy an existing cash flow generating business? Right. One of the big reasons we also got into the space is this silver tsunami of baby boomers that are retiring, that have started really good businesses in their local communities, that have employed local employees. And there's this natural aging process, right? You can't reverse it. They are starting to age. Their kids don't want those businesses, even though they're good cash flow generating businesses. And so we saw this as an opportunity to help underrepresented entrepreneurs take over those businesses and continue running them.
Yeah. When was the fund originally founded? How long has it been around?
Technically, we launched the fund last year. We did our first close on Juneteenth last year. We had several foundations, including Skoll Foundation, including the Vision Fund at Philadelphia Foundation, come in as early investors. And since then, we've actually also deployed capital from some of the first closes of the fund. So the fund is very much live and alive, and it's also raising money on a rolling monthly basis.
Yeah, so as we're getting into those details on the numbers and the fund here, I want to open it up to either Michael or Kevin to jump in. But yeah, how large is the fund in a more broad sense?
Yeah, the fund is targeting about 50 million, 50. We've done the math. The minimum viable size for us is about 2025. So, we'd be happy with whatever range we end up there. To date, we are close to 5 million and on track to get to about 2025 by the middle of this year.
Hmm.
So I'd love to just kind of walk through a little bit the process for the companies you're working with. How do you find them? How do you work with them? How do you finance them? How do they spin off into their next level of existence?
Yeah. So Michael, we really decided to focus on the entrepreneurs themselves and give them the tools to go find a good business that's a good personal fit for them, financially, professionally. So initially, instead of being a matchmaker where we're trying to find a business for sale and match it to an entrepreneur, we decided it's best for the entrepreneur to go out to the market and find a good business. So with that in mind, we started a nonprofit foundation, New Majority Capital Foundation, which is a 501(c)(3), which itself has received funding separate from the fund. It's a whole separate organization, but it received funding from JP Morgan Chase Foundation. It received money recently from the Bill and Melinda Gates Foundation, from the McKnight Foundation. And that foundation is now able to run what we call entrepreneurship through acquisition accelerator programs, where we take groups of 36 entrepreneurs, and these are place-based programs. So it's a hybrid program, but we run them in Atlanta, in New York, in DC. We're going to be in Detroit next year, Minnesota coming up next. And these entrepreneurs learn everything they need to learn to be competent and confident in going and finding that business, engaging with the seller confidently, giving the seller, good value for their business, and then executing on that transaction. Right. And the execution of that transaction typically happens in combination with a bank. So the banks in the US through the SBA 7A loan program can offer up to 90% of financing for the acquisition. And it's not collateral-based lending, it's really cash flow-based lending. But the banks need the entrepreneurs to put up 10% of equity or down payment. And we've created an ecosystem of investors that can put that equity up. But we, as a fund, have also set up our fund and structured it in a way where we ourselves can provide that equity gap for these entrepreneurs to go buy these businesses. And that's typically how it's structured.
So the grassroots investor advocate in me says those raises are really ripe opportunities for raising capital through investment crowdfunding. Is that one of the ways that it happens?
It could happen. We haven't seen an entrepreneur do it so far. Quite frankly, New Majority Capital, we ourselves raise money for a management company through a crowdfunding program on vFunder, when we first got started. Because, as an emerging manager trying out a new strategy, the typical challenges are, what's your track record? Do you have operational capital to stay in business? Do you have money to put up a GP commitment? And we didn't come from, a whole lot of money. We came from the for-profit world, but we saw the need to sort of raise that capital. And luckily, we found that capital through a crowdfunding platform.
But I'm
But
talking, but I'm curious though about the entrepreneurs. I mean, what is the range of capital that they're going to need to put up for that 10%, and how are they raising it?
yeah, so depending on the size of the deal, it's typically about 50,000 to about $300,000 in down payment is what they require. For the most part, they are relying on family and friends, but from an impact perspective, our fund is set up to help them regardless of whether they have any cash on their balance sheet or if they have or do not have a network. Through the training program, we make sure they are trained to pick the right businesses and to present it in a very objective manner, which sort of demonstrates to investors, why this business can continue generating that cash flow and how that cash flow can then be used to return investors' money back.
Got it. And for your own cash flow, where are the various requirements for people involved in the program to pay fees and the like?
Yeah, so we've designed the fund to provide that equity gap financing in as much of a entrepreneur-friendly manner as possible, right? For us, impact is the North Star. So we call it non-extractive capital. There's a whole conversation to be had about what that means. But typically, the way we structure it is using a modified revenue-based financing model. But it's modified in the sense the cash flows coming back to the fund for its investments are not coming from the top line revenue. They're really coming from the bottom line cash flow that's left in the business every year. So after they finance the debt, they pay their working capital, they leave some money in the business for CapEx. We also mandate that 10% of the profits go to the employees in the business. And then after that is when we get a share of that cash flow coming back to our investors. But that last piece, I just wanted to double click on it because I didn't mention it earlier. From an impact perspective, we're really excited about this part about sharing profits with employees. It's not a ESOP or an EOT because some of those structures are too expensive and maybe not as effective at the smaller end of the market where we are playing, which is, $500,000 to 2 million EBITDA, or maybe 5 million to 7 million in revenue, 5 to 10 employees. Sometimes an ESOP may not make sense. But that profit sharing model, we see that as being pretty powerful because, somebody gets a 5K check, a 10K check at the end of the year, it makes a huge difference to them. But it also then helps align everybody with the transition. The employees are more excited about the new owner and they're more excited about the growth prospects of the business.
Let me ask just one more question, then I'll pass it over to Kevin. So it sounds like you have run these accelerators in a small number of cities. How did you decide what cities to pick, and what cities are you looking at next?
Yeah, we did a an MSA analysis, metropolitan statistical analysis on which regions in the US have strong, wealth gaps, where the inequality is high due to race, due to class, due to other factors. We then also looked at, what is the percentage of businesses whose owners are approaching retirement, right, who are over 55, over 60 years of age. And then we looked at, the population makeup and the education qualifications of the population there to sort of understand, is there going to be enough entrepreneurs there that we can train locally to then buy those businesses locally? So based on that, we came up with a list of cities. And then when we went to grant funders, we shared that list and we sort of matched up with what their interests were, right? So some of the foundations that are backing us have their own analysis and have their own priority cities. So far we've been, aligning with them. So we've done programs in Providence, Rhode Island, in New York, in DC, and Atlanta so far. Going forward, we're doing programs in Houston, in Detroit, and then Minnesota, North Carolina, and LA are on the short list.
Great. All right, Kevin, over to you.
Yeah. So I think you just started Houston this week, from what I was saying. Looks like the 11th.
Yeah, we did an initial info session to sort of inform people about this program so they can then, apply to join the program. Houston officially kicks off in March.
Okay, so you just had the session there. Okay. And where are you going in North Carolina, since that's where I live?
Yeah, we haven't picked the right perfect city yet. It's probably in the north, in the triangle region, but happy to and align with you on what you think would be the best place.
Yeah, most people pick Durham because it's easy and but it's more highly resourced than some other things there. So anyway, I'd love to talk about that. I need to say, I'm not objective here. I was a WeFunder investor when it was a concept. I mean, this made so much sense as an idea, and I've been pulling for Havell since then, and it's such a great idea. I posted in the chat something that Forbes wrote that has been in your social media. Is new majority capital the solution? And I think you're starting to be seen as the answer, because it really does reduce the risk of a startup. And there are people my age who do retire. I'm even thinking about it someday in some near future. My wife wants me to think about it more. And, so anyway, after we're doing Havell will be speaking at our conference April 1st and 2nd, Neighborhood Economics, in Asheville, North Carolina. We'd love everybody to come. Michael will also be speaking there, and obviously Joel will be there because he's in our town. But what do you see about where I long time ago we bought the Mississippi Business Journal with another couple, and it had failed 5 times, and it had 3 stronger competitors, so it was available for really cheap. And we had a successful trade journal that I'd rather talk to more people than the people who grew catfish. And he thought he was an entrepreneur, and but he wanted to go home at dinner. And it's like, dude, we have 3 stronger competitors. I mean, and it took him about 1.5 years to realize he was not an entrepreneur. He imagined the number of people who imagine they are entrepreneurs compared to the number of folks who will work as hard as it takes. Because we within 3 years our competitors were out of business, and we had a trade show, and we had a syndicated radio show on 37 stations and a TV show on 12 stations and all that stuff. But the imaginary entrepreneur, and you have an accelerator, but what's your process for helping the delusional would-be entrepreneur realize it means working through dinner, fool?
Yeah, no, that's a good question, and we're always trying to fine tune, how we can get better at it. For now, what we're really screening for is, grit, empathy, and a sense of curiosity, right? We don't care whether the person has an MBA or not. You don't need an MBA to run a landscaping company or a HVAC company or even a small manufacturing company. But as an entrepreneur, they need to demonstrate that grit, right? They're going to show up every day. Challenges are going to be thrown at them. They need to sit up late. They need to figure out things, be a problem solver. Curiosity is important because they're learning, they're taking over a new business. And then empathy is the third pillar, which is important because they're taking over a business that was, already has employees that have been working there for years, that have been loyal to the previous owner. So a lot of soft people skills, matter in this space.
Yeah.
So yeah, it's hard to, quantify objectively.
Yeah.
There's a test and you fit this thing. It's more a sense of, I guess for now, it's it's an interview process and, asking them questions to demonstrate, how they've been gritty. We do, in the program, we do expose them to the SBA 7A loan program.
Right.
And which requires them to take a personal guarantee on the loan, right? So it's not necessarily free money, at least on the debt side of the piece. On the equity side, we could lose our shirts, we could lose our money, but that's a risk we're taking. But on the debt side, which is a bigger portion, they have to take a personal guarantee. So this is not something they can just, take.
Do they need collateral or just a pledge?
Just a pledge. It's basically, as long as you have a minimum credit score and, about 625 or 650, depending on the bank, they're fine.
Right.
The bank don't need assets on their books necessarily.
Right. Now, I've invested and engaged with entrepreneurs, 14 times, and I succeeded 12. But the 2 I failed on, I got diluted by the same thing. I invested in geniuses who had a holistic, wonderful story that I bought, but they never built a team beyond themselves, and they stayed the number one salesperson. The genius could not transfer and parse off, I'm direction your sales. How do you look at that? I mean, I've recognized that delusion in myself. I don't, have not made that same error. I made that same error twice and recognized, damn, I did the same damn thing wrong. Don't invest in it. You have to discount a genius. That's what I think. How do you deal with the fact that, where they can't grow the business beyond themselves? They stay too much entrepreneur centered.
Yeah, no, that's a that's a problem that I relate to as well. I've been
Yeah.
an entrepreneur for a while, and at some point you got to let go and delegate in case you.
Yeah.
So we do train them on these soft issues. We have various modules in the program, and it's not just finance; it's also operationals, HR, scaling strategies, marketing, and sales, so they can understand what all is needed. But the second thing is we train them to look at businesses that are more mature, right? So it's when owner himself,
Right.
current owner, is not doing everything. There's probably a general manager who's running the place. There's a sales team in place, so they don't need to come in and do everything that the previous owner was doing. So
Right.
as long as they select the right business, they should
Right.
hopefully they listen to that inner voice
Sure.
and not do everything themselves.
Entrepreneurship through acquisition kind of mitigates against the genius. It's cash flowing. It's already real.
Cash flow, it's very humble.
Yeah.
These are not sexy high-tech businesses. These are
Right.
dirty, and work through it.
How many of them are brick and mortar versus service?
Let's see, in the 20 companies that we've helped get acquired so far, I would say about 15 are service, and then the rest are brick and mortar. And by brick and mortar, I mean, small niche manufacturing businesses.
Right. So 15, and what's the number of the other side?
5, roughly.
So 5 are not service.
Yeah.
Okay, and 15 are service.
Right.
Can you describe just a range of what are some of those service examples?
So there's a home healthcare service company that was recently acquired. The entrepreneur bought one, and now he's buying a second one in that same space. There's a med spa business that's coming through. There's a accounting bookkeeping company. We consider landscaping, HVAC type businesses as service businesses.
Right.
Yeah, there's a variety. I mean, the economy runs on all these small businesses. It's not just big.
Yeah. And why is it 75% service versus 25% small manufacturer?
Honestly, it depends on the entrepreneurs and what they're attracted to.
But it doesn't really, because if it's 75-25, there's something about this that thing that service 3/4 service. There's a reason.
Right. Probably it's because when we train them to look at businesses, we're training them to look at, and this may work for, maybe I'm contradicting myself, but we train them to look at businesses with some sort of repeatable customer base, some sort of repeatable revenue as much as they can. Right. So like a landscaping company is a good example. If it's embedded in a nice community, as long as you're going to get the same customers coming back year after year. The customers don't typically sign a multi-year contract, but if the relationship and service is good, they'll keep coming. Yeah. So because we're training them to think about stability of cash flows, you get attracted to that.
Great. Nicole has asked a good question. Nicole, do you want to go ahead and ask it in the hey, glad to see you again.
Yes, thank you. Happy New Year, everyone. Nice to be here. Thank you, Havell, for your time. My question was, are there any examples of owners who are also aiding these business transitions with maybe more patient capital or more alternative, like rather than a full payout? I'm assuming owners want their business to keep going and are part of this process. Are there any examples of that where they might take payments over time or some type of financing model that is not outside capital related or bank related?
Yeah, no, that's a good question. And
Thank you.
we typically mandate that the sellers at least have 5 or 10% of a seller note in the transaction, so they're not taking all the capital and walking away on day one. Typically, there are two things we mandate. One is there's a consulting agreement in place, so they stay on as a consultant for a year, and teach and train the entrepreneur on what they don't know. And then the second piece is out of the total acquisition value. Yes, some of the cash is paid up front, but at least 10% is paid over a 5-year period or a 7-year period. So it's not cash walking out of the door. It's a little bit more patient. Sometimes we help entrepreneurs structure it where that seller note is a bigger piece of the pie, and that bigger piece could be tied to specific milestones. Because sometimes a seller might say, my business is really worth 4 million because I've got all these big contracts in the works. You're willing to pay me only 3 million. And so we sort of come and bridge that gap by saying, okay, you'll get this additional 1 million or maybe more if these certain milestones are hit. And so, we're seeing more of that become common. To your point, sellers really care about these businesses, right? They became rich from the cash flows. They've got personal relationships with these employees. They care about that legacy piece. So they are willing to sort of stay aligned. And more recently, the SBA 7A also changed its rules to allow for owners to retain equity post-acquisition, especially in asset purchases. So that wasn't the case earlier. So now you can structure deals where you can leave some skin in the game for the seller, so they can get a second bite of the apple, or at least be more aligned and involved as well, as much as they want to.
For me, that raises another question about how you actually do the valuation. I mean, I appreciate it's always a little bit of a negotiation, but do you have one go-to methodology that you use?
Yeah, so it's the most common practice is to understand what is the seller discretionary earning in the business, and then come up with the adjusted EBITDA. So it's not the net income necessarily reported on the tax form. It's it's that plus any other add backs. Most small business owners are running personal expenses, on the expense side of things, so they can minimize their taxes. So we need to figure out exactly, there's a process by which we can figure out, okay, what cash flow of this business that's paying the seller's salary, that's paying the seller's lease on his BMW, or seller's wife for doing nothing, but maybe they're doing something that's not super clear, or maybe it's their nephew doing something. So once you arrive at that number, then we can apply a multiple to that number based on peer.
Right.
So we subscribe to databases like BVR, Deal Stats, peer comps, where brokers and banks report on the acquisition multiples that they paid on these STs. As a rule of thumb, typically for this end of the market, because private equity is really not interested in this smaller end of the market, we are not competing with high multiples. The multiples range, somewhere between like 3 and 4.5 times that seller discretionary earning.
Right. How do you deal with goodwill? We've had 8 out of 9 successes in my business career, 8 successes with my wife and 1 without her. So anyway, that's another point to add. But 15% is a typical number, and we've twice gotten it up to around 30 because we had that much goodwill we could show. They would pay more for us. They liked our little thing. How do you deal with goodwill, and how do you deal with it?
Yeah, I mean, most service businesses, they in the asset purchase of things, goodwill is a bigger chunk of that value, right? Like home healthcare service company, what is the assets coming along? It's some furniture and some computers,
right?
Things like that. But if you're paying a 3x multiple on a $500,000 EBITDA, the bulk of it is the brand, it's the customer base, it's the know-how, etc. So luckily, as I was saying, that SBA 7A program has been set up in a way that can overlook inventory and collateral, and they're okay to finance it based on whatever goodwill values coming along, as long as the multiple makes sense. The advantage for the buyer is that goodwill can be amortized over a 10 or 15-year period.
Mm-hmm.
So they get a nice tax benefit out of buying a business as an asset purchase. So that sometimes is not factored into the equation with sellers, but it's a nice little cherry on the top.
I'd love to open it up now to our audience. Peter's here, Ian Fisk is here, folks I know who really are knowledgeable, along with Nicole is already. But anybody have questions?
I actually want to disagree with my esteemed brother and mentor, Kevin. I don't think that necessarily the formula for success is CEOs working 70 hours a week. I mean, yeah, gritty tenacity and time-life balances and slowing down and bringing more soft skills into the C-suite are things that I've been working on for the last couple of years. And the future of leadership is teaming. Benevolent dictators and people who can't delegate. I mean, that's a pretty low-level standard in terms of how a team should operate.
Really good points. Yeah.
Yeah, no, well, just teasing you too.
Well, when we bought something that had failed 5 times and was losing money and had 3 stronger competitors, it meant we had to work along. That first year, 2 years was, by the 3rd year, our competitors were dead and we were living normal lives.
Working hard is something we're all used to doing. And,
yeah.
That's I'm not gonna stop working with your track record. I just want to give you all my money.
I don't want to have the responsibility of anybody else's money. That's one of the reasons I stopped. But anyway, okay.
Yeah, at least half of it. I think, Michael, what you meant, the disappointment of the potential of the Jobs Act, I think is evident to a lot of people. And in terms of a lot of smaller stuff like this, a missing element for me is like the lack of information. How do you really corral it? So much of it is marketing driven in terms of, so is there kind of like social capital crowd serving agencies that have full service that can be reasonable for small people to come in and do kind of crowdfunding if there's enough, but it costs some money. But some of these big A++ $75 million Wall Street guys that are just chewing this up, they're charging 20 to 30% fee structure, which is fine if you raise the money. I mean, there's professional fundraisers that do that too. Dan Pelota, taught me, don't worry about that. How much impact can you have? So that's one thing that I think that the resource is missing there to better utilize this. And how about this is really new to me and really fascinating. And I don't know if you're dealing with any native entrepreneurs or businesses, but there's down payment money. You talk about 300,000. The native CDFIs are very friendly towards that kind of down payment. If you need some contacts there, I'd be happy to share them with you. It's so that's and then there's a woman named Dawn McGee that's an old SVNer that's running money for a progressive family up in Montana that has Goodwill Ventures. They're not that active, but they've been basically taking Montana businesses that don't have succession plans, don't have kids, and they finance and bring in a management team to take over. So there's some similarities in what you're doing there. The BIPOC population in Montana aside for a minute, but there's some, they're very progressive, and it might be a good peer for you to talk to, Dawn McGee at Good Works Ventures, but I can connect you to that also.
Yeah, thanks, Peter. I'll follow up on both these. Yeah, we are starting to market the program to more of the Native American indigenous populations. We are quite hopeful we'll get a good number, especially in Minnesota and the tribal nations up there. And I think there's one CDFI, like the one you were mentioning, that can provide that down payment as a grant for them, but happy to look at other resources as well.
Yeah, Oyster's the one that I know best, but yeah, but they're connected nationally. And I'll put my email address in the chat. Feel free to reach out.
Yeah, and would love to talk to Don as well.
Yeah, great.
Question, out of curiosity. So I am an example of someone who did not follow up in running his parents' businesses because I was not going to stay in a very small town. And so y'all got stuck with me on my career path. Many of you know, many of you are mutual friends with Raj Agarwal, who was in a similar situation, although he was at least in a larger town. But how involved are the folks who are owning the businesses? Because I know in some of the personal cases I've seen around this, that they know the people they want to bring in, but there's just like, are they involved in helping you find making the connection?
You mean the owners who are selling,
Yeah.
or in a few cases, yes, but for the majority, it's been the buyers that have been actively going out, and they've mostly been talking to brokers. There's a like real estate. There's a whole community of brokers that represent business owners, and they typically find acquisition deals through the broker network.
Curious, is that angle?
Yeah, I have a question too that I'm wondering on the progression, kind of going back to what Peter said about, businesses really are a collaborative effort usually for the most part. Are any of these transitions, have there been any interest, or has any of the owners, or have you guys yourself looked at possibly any transitions that are to worker ownership models, in addition to the entrepreneur through acquisition? Has there been any talk of trying to do worker ownership models through acquisition?
Yeah, I'll say a few things. One is the fund itself, the way we are structuring our exit, one of the exit options is going to be an ESOP. So if it's big enough, there's enough of an incentive for the new buyer to exit out that way. Or, for us to take, once we've returned our target returns to our investors, for us to then take our equity and then, grant it to the employees in the business. So that's how we're thinking about that space. But on another note, the foundation that we started that runs the training program for the entrepreneurs has also started receiving funding for another program called Succession Ready. And Succession Ready is specifically designed for business owners, existing business owners who are approaching retirement and who want to understand what their options are, but also want to understand what the process is to get their businesses into the hands of either their employees or their kids or to a third-party individual. So through that, we run 2 programs so far of Succession Ready with about 45, 50 people going through. And I would say at least 5 of them are actively looking at employee ownership models as a way to exit.
Yeah.
Yeah.
I appreciate the level of education there, because it definitely seems like when it comes, there's a lot of business owners that I've been around in a lot of these events and things who all have very strong values for the start of the company and for the beginning and kind of setting that. But a lot of times there's not enough education on how to maintain those values in the personal exit of the company, because no one person is going to live forever to keep that business going. So yeah, I appreciate that. Any education that people are doing on the ways that they can maintain their values through even their exit is, that's fantastic.
Yeah. Havell, you mentioned that ESOPs weren't an option on the front end because ESOPs are too expensive for the size of the acquisition that you're doing. That seems like it's a missing piece of infrastructure. There should be a way to do employee ownership that's cheaper and that works at the level where you're investing in. Do you think would you like, should there be
Or
something there?
EOTs or PPTs, perhaps. Yeah.
I just got exposed to it. Another brother who was expert in this field, Clark Arrington, who has a long history with the Post Company, journeyed on this year. And right before he passed away, he connected me with the CEO of a co-op corporation that he was general counsel of, called O'Brien.
Yeah,
Very
right.
short period of time, they acquired companies and made them worker co-ops. There was no ESOP. The ESOP is not the only option. And these worker co-ops, I mean, there were 4 different companies, 40, 50 million in revenue and over 400 employees aggregated. So, there are other options out there.
Yeah.
And, and they were financed in creative ways, the acquisitions. So
He was amazingly creative. Yeah. But, is there a way to do the small? I mean, Obrand, it becomes a holding company or becomes an investment bank. I'm a big fan. Okay. I just wonder if there's some lightweight thing without being Obrand.
Yeah, we can
They
look
could do
at
that.
employee ownership trust seems like an interesting.
Yeah, the EOT or the PPT, but that would,
Yeah,
yeah.
exactly. Yeah, ESOPs, I mean, there's Apis and Heritage that's doing a good job.
Right.
Slightly larger deals,
in Boston, there is an accelerator that is specifically for co-ops. And
right, sure. The start.co-op folks.
I forgot his name, Ian. What's that?
Greg,
yeah, that's it. Brodsky.
Yeah, Brodsky, there you go.
He's
Yeah.
a great resource for smaller startups. He has a little sidecar fund also, I think.
Right. I'm in that fund, but again, it's not solving this problem for a new majority capital where there's a lightweight vehicle without going into an accelerator. Anyway, I don't know. Maybe it isn't time for that.
So I have another question that maybe opens up an opportunity for partnerships with local governments. So local governments in their economic development policies are always calculating dollar costs per job. And of course, this is one reason why attraction strategies are so miserable, because they are $100,000 to $1 million per job. I'm curious if you've had a chance to do some like back of the envelope calculations about what the job creation opportunities are for people who give you money. And if they're really low, which I imagine they are, I would think there is a great case to be made to, a local government and the economic development department and network of agencies for a partnership, no?
I think there's something there. We definitely can quantify the job retention piece. That's an easy thing, right? If the business is sold, it retains those jobs in that local economy. But yeah, we can look at cost. We can look at job creation as well. We have in the past got funding from Rhode Island Commerce, which is a branch of the Rhode Island state government, because they were concerned about sellers retiring with no succession plan in place. So there is a case to be made that state government agencies should be putting more resources behind the existing small business ecosystem and giving people more tools on how to exit their business or leave the business behind for other people to sort of continue running it.
Great. And let me ask another question too. I mean, we've talked a lot about the acquisition itself. Once the acquisition takes place, how do you support the entrepreneurs? Who are the people who do that? Are there expenses associated with that?
Yeah, we are in the process of building out, what we call back office concierge services for all our portfolio companies, and that would be in 4 basic operational practices. One is finance, accounting, bookkeeping. The second is sales and marketing. The third is operations, especially digitization of operations, and then the fourth is HR. So we're starting to contract out with some portfolio companies who are operating in these specific niches and having them become a concierge service to the rest of the portfolio. Because as a small business owner, it's tough, everybody knows they need to do marketing and sales, but they don't have the bandwidth or resources to look at who the service providers are and what the right strategy is. So our intention is to create a best-in-class service that they can then tap into and lean on for growth and for just stabilization of cash flows as well.
Is there a community of practice so the people who say we're in the accelerator program together stay in touch, work with each other?
Yeah, there's a, when they graduate, they become part of our Slack community.
Hmm.
Where they, that we have close to about 1,000 people, I think, in the Slack community now. There are not some folks who went to the program and folks who are just generally interested in entrepreneurship through acquisition as
Right.
well. And that's becoming, that community is growing and is becoming we're seeing quite interesting conversations happening where groups are forming, where there's a group of folks interested in landscape and they're spread across the country. So they're not competing with each other, but they're sort of sharing best practices in terms of due diligence. At least for now, it's mostly on the front end, but hopefully after some time, there'll be groups of individuals who went to who all acquired landscaping companies and now are looking at, best in class practices.
Right.
Yeah.
Are you finding groups of angels from the places where you set up, like you just opened up, or you had a session in Houston, you'll be there in March? Are you finding that local impact investors, if you will, or local investors join you when they see this?
Yeah, that's definitely happening. And some of those investors, some of them are fairly large, and they are also asking for side letters from us, which we are open to, which basically would say if they are putting money into the fund, that money needs to be set aside for investing in their local region. Because they can see that the accelerator is creating that pipeline of entrepreneurs locally. And now they're sort of bringing the capital to the table so those entrepreneurs can tap into that local capital to buy those local businesses as well.
All right, if I could have time to squeeze in one more question
You
here.
got it, Mike. All for you.
Okay, so you've been operating for a year. You've been learning things as you go. How have you had to tweak the model from what you've learned over the last year? And I guess a related question is that I mean, it's probably too early to discern successes and failures from the businesses. I mean, you'll need like a 5 or 10 year retrospective. But if there have been any, crash and burns, what you learned from that?
Let's see. In terms of tweaking the model, I think we've become a little bit more flexible in the structure with which we're investing. At first, when we created the model, it was a pretty well-defined thing, which was like, 80% debt financing, 10% seller note, 10% equity coming from the fund. And then as we started doing deals, we realized we need to be a bit more flexible. Some sellers are willing to hold a larger seller note than others. Some want equity in the business. So we've started to become a little bit more flexible in the way we deploy capital, as opposed to saying, no, this is sort of the fixed structure with which we're going to operate. And then in terms of lessons learned, so far, touch wood, all the businesses have been successful in the sense that they've been able to pay back the acquisition financing on time. They haven't defaulted on any of the loans. A few of them have demonstrated doing multiple acquisitions in the same space. A few of them have grown their teams. Sorry. One in particular, though, was one deal, though, struggled a lot initially. And that was because, the seller had just some bad practices that we couldn't discern when we did when we did the due diligence. And that happens, in the small business world, no deal is going to be perfect. There's always hair on those deals. The processes sometimes are not transparent. Sometimes there's cash operations happening on the side that we wouldn't know about from the outside. Yeah, so there have been some instances like that. So that we've learned from.
All right. Well, thank you.
Thanks
Can
so
we-
much, Abel, for joining us here today. And thanks for everyone that joined to ask questions to be a part of the conversation. There's not many spots that are having these types of conversations on this level. We do have an archive of them on the Main Street Journal. We're also working to put an archive of them up with Impact Alpha in this coming year. But until next time, what is our next one? Do we have one 2 weeks from today? Is that scheduled, Michael? Or are we, I believe we do. Can we tease who that is?
Jen, you are the keeper of the schedule.
Yeah, Jen, help us out. So, the rest of us would have to actually look at our
Yes,
calendars from
the
time to
keeper of the
time.
schedule is trying to find a link right now, but I will definitely send it out to those who are leaving right now.
I think it says New Jersey Capital, Jen. I
Thank
just couldn't remember
you.
who the person
Yes.
was.
Wonderful.
It's
Yeah,
yep.
New Jersey Capital in 2 weeks. So same
New
time,
Jersey Community
same
Capital.
place. We'll look forward to seeing you all next time. Until then, take care of yourselves and remember, we are each other.
Thank you. Bye-bye all.